Hello and welcome to another video on how to secure yourself financially. Here in today's video, because I already know the basics of how to read financial statement and recognize that financial statement, after all, they show you the money. And there are four types of them. You have balance sheets that show what a company owns and what it owes at a fixed point in time. The TLDR of this is a snapshot of the company assets, liabilities, and shareholders over a period of time. The income statement that show you, how much money a company made or spent in a period of time. So the TLDR of this is, think of this as a set of stairs that you start at the top with the total amount of revenue, and once you go down each step, you make a deduction associated with that cost. So for things like merchandise return and discounts, once you deduct that, you reach to the net revenue. And broadly speaking, after you deduct things like the cost of sales, among other expense, you reach to the gross profit. And here you deduct things like operating expense, so expense that a company incur for their day-to-day activities like marketing, administering salaries, developing new prototypes or improving one. Also, the amortization and depreciation. So once you deduct this, then you reach to the operating profits before interest and income taxes. And the interests are money that a company lend or borrow that affect is the income statement, and the income taxes, money that you owe to the government. So at the bottom of the stair, you see if a company made profit or not. And the cash flow statement reports the company inflow and outflow of cash flow. And this is very important because, like people, company needs to purchase assets or pay expense. So if we use some information of the balance sheet and the income statement and the cash flow statement, review the cash from one of these activities: operating, investing, and financing. So the bottom line of this show the net increase or decrease in cash. So when it comes to the operating activities, which is the first part of the cash flow statement, what it does is to conciliate with the total amount of cash that was used or perceived for other operating activities with the net income from the balance sheets, from the income statement. And broadly speaking, these operating activities can be broken down into operating assets and operating liabilities, where on operating assets you have things like accounts receivable, prepaid expense like health or premium insurance like health, car, vehicle, liability, disability, long-term care, as well as rent, marketing, software license or software service, as well as software license, as well as maintaining contracts are example of prepaid expense. Intangible assets is another common operating assets like patents, copyright, trademarks, trade secrets, goodwill, customer relationships. Intangible assets is another common operating activities like joint ventures, equity investment, associate, limited partnerships, subsidiaries. Cash and cash equivalent, another common operating asset. So for example, like money market funds, where these are, so this involved in the purchase or sale in very large volume of short-term debt financial instruments, with the whole idea is to earn fast liquidity. So for example, this fund invests on bank acceptance, very short-term debt issued by banks, certificate of deposit, which is savings certificates with short-term maturity, commercial papers, risky corporate debt, short-term corporate debt, repo, which is short-term maturity securities issued by governments, and U.S. Treasury, which is U.S. or particularly government short-term debt. So then I look at the most common liabilities. Okay, like the most common operating liabilities, like accounts payables, accrue expense like salaries, rent, utilities, taxes, deferred revenue such as subscription service or gift cards, income taxes payable like corporate taxes, withholding taxes, or the sale taxes, whether it's local, regional, state, federal, foreign, as well as excise taxes, a tax imposed on certain goods and service, specifically goods like gasoline, sorry, like gasoline, tobacco, alcohol, guns, VAT, the value-added tax, which is a tax imposed at every stage of the production and distribution of good and service, where the customer ultimately pay the full VAT. So business along the supply chain remit that portion to the tax. And something called the GST, the Good and Service Tax, which is a tax imposed on the VAT in places like Canada, India, and Canada, India, and Australia. Keep looking at other most common operating liabilities like short-term borrowing, just from banks, line of credit, trade credits when you renegotiate with your vendors and suppliers, an outstanding invoice. So based on the value of your invoice, the lender will evaluate that and may or not provide you with a loan as a company. The the other is how do you put it? Yeah, I keep looking at short-term borrowings here. Payrolls advance, but now this is to employers. That will be deducted in the next payday, as well as notes payable. So this is for companies that want to meet their financial needs. So anytime, for example, you where a company asks a loan to a bank, it generates this note payable because it is agreement between the borrower and the lender that outline the terms and conditions of that loan. So, for example, the principal, the interest, the repayment schedule, among other details. Business is another way to create these notes payable. So instead of going to banks, you now go to this financial institution or private equity, venture capitalist. Issuing bond is a way also to generate and raise funds as well, to generate these notes payable, whether it's for governments or companies. Trade payables, which is now an agreement to some companies do that. It's an agreement to your suppliers and vendors to renegotiate these repayment schedules. So then I also look at individual notes payables, where now this is directly to small business or individuals, all right? You want to raise funds from them. And also warranty obligations, which are obligations that a company have to fix or replace a defective product on a period of time, on a certain period of time, or a product that doesn't meet certain quality standards, right? So with that, okay, then I look at the way of how it conciliate these operating activities to the cash flow. Conciliate is the total amount of cash that was used or perceived from one of these activities, operating activities, with the net income from the income statement. And what it does is to look at the total amount of cash that was used, so look at the net income and the non-cash items, so items that affect the income statement, such as amortization and depreciation or stock-based compensation, as well as conciliate the total amount of cash with other operating assets and liabilities. So the second part of the cash flow is the investing activities, where generally speaking it refers to the purchase or sale of long-term assets, such as property, plant, and equipment, investment, intangible assets, leasing, improvement. So the third part of the cash flow, which is the financing activities, this section focuses on how this company raised funds and how often and where the source of this money came from. Because this financing activity involves the company's long-term liabilities and equity. Most of the time is ownership. Generally speaking, is ownership, or is if you have an asset and once you pay off all of your liabilities, that is the equity. So generally speaking, this also involves is how a company raises funds from investors and creditors, as well as the repayment debt and distribute dividends. So Investopedia mentioned that. So this section, which focuses again on how a company raises funds and pays back to the creditors or investors or investors through the capital markets. So this section also helps investors to see how a company is raising funds, how often, and if a company is, if its main cash flow comes from business activities or the operating activities, that's a good sign of investment. However, if a company constantly is raising funds from taking out debt or issuing bonds or stocks, that might not a good sign. Again, that might be not a good sign of investment. There's some nuance in that. There's a lot of nuance, but this is something that Investopedia mentioned. So most of the time, these activities in the financing aspect involved is issuing equity, issuing debt. By issuing the equity is most of the time they're issued an amount of shares. This is something that happened when a company go public in this IPO, initial public offering. As issuing equity, issuing debt. So this company issuing financial debt instruments like debentures or bonds, notes payable, repayments, debt, redistributing earnings, repurchasing stocks, leasing, which is as a company, I can give you the right to use some of my assets, whether it's equipment or building, but not the ownership. And this is something interesting to note. So once I look at that, okay, and as well as the footnote, and how important is to read the footnote, because it packed with information like accounting principles and policies that the company must disclose this, and how they have been adhered to, for example, GAAP, these generally accounting principles, or the International Financial Reporting Standards, which is a set of standards, especially because most of the time all of these companies has growth exponentially. They have become now multinationals, and to make this financial statement transparent, easy to share, they create this standards. Income taxes is another topic you can find at the footnotes, where here is describing in a more fine detail about the income taxes for state, federal, local, foreign, payment plans, and other post-retirement programs or post-employment programs. This is discussed also in detail, and see how well or by how much the plans are over or underfunded. And then I look at the stock options, which this is our equity options, or an opportunity for companies to employees, so they can invest in the company stocks at an agree upon price, or an agree upon price and date. So this is also known as equity options or equity derivatives, where this means is that the value of these stocks is based on an underlying asset, uh, whether it is natural resource or an index, currencies, or another stock as well. And there are two types of stock options. So you have calls and puts. So calls are bet that a stock will grow, or are bets that a stock will rise, and puts are bets that a stock will fall. And so understanding this, the stock option, okay, then I look at the read the MD&A. So you can find a narrative explanation of a company's financial performance in a section of the quarterly or annual report entitled Management Discussion and Analysis of Financial Conditions and Result of Operation. Holy. Management discussions and analysis of financial condition and result of operations. So this is a narrative explanation of a company financial performance in the section, okay, in the financial, okay, it's a narrative explanation of the company financial performance quarterly or annually, entitled Management Discussions and Analysis Financial Condition and Result Operation. So the management discussion and analysis of financial condition and results operation, which explain or create a narrative explaining is the company financial performance at a given time or a particular time frame, whether it is annually or quarterly. So MD&A is a management opportunity to provide investor with its view of the financial performance and condition of the company. MD&A is a management opportunity to provide investor with its view of financial performance and condition of the company. It is management opportunity to tell investors what the financial statement show and do not show here. It is management opportunity to tell investors what the financial statements show and do not show. Okay. As well as important trends and risks that have shaped the past or are reasonably likely to shape the company's future. So this is another section here at the, or another information you can find at the financial statements, okay? The MD&A, which is a narrative that explains the performance of the company financial performance over a time frame, over a period of time, such as quarterly or annually, okay? The management discussions and analysis of financial conditions and results of operations. Okay? So it is a management opportunity to tell investors what the financial statements show and do not show. Okay. This is useful for investors. What it shows and do not show, as well as important trends and risks that have shaped the past or are reasonably likely to shape the company's future. The SEC rules governing MD&A require disclosures about trends, and so the SEC rules governing MD&A require disclose about trends, events, or uncertainties known to management that will have the material impact or reported financial information. And I think they make this because the SEC, after the huge market crash in 1929, so and also the gap was invented as after that. If you take a look at this, yeah, when and why we were gap first established. Following the stock market crash in 1929 and the ensuing Great Depression, the U.S. government sought ways to regulate the practice of publicly traded companies and other major market participants. The government believed that at least some of the costs for the crash were due to less than above board practice by publicly traded companies. But it doesn't tell you when it was created. Authority to set standards on accounting practice was granted to Security and Exchange Commissions. Authority to set standards on accounting practice was granted to the SEC. The SEC decided to delegate this responsibility to the private sector auditing community. And in 1939, the American Institution of Accounting, precursor of the American Institute of Certified Public Accounting, created the Committee on Accounting Procedure. Committee of Accounting Procedure was replaced by Accounting Principles Board 20 years later. The APB began issuing opinions about major accounting topics to be adopted by business accountant, which could then be imposed on publicly traded company by the SEC. In 1973, the APB gave way to the Financial Accounting Standard Board. So, but again, so the reason why I'm looking at this is because on the SEC, okay, so the SEC, and the reason why we have things, topics like the management discussions and analysis of financial conditions and results operations is because after the huge market crash, which it happened in 1929, that last 12 years to recover, for the market to recover, 12 years, you're gonna fucking kill me. So the SEC, okay, created that. So the government delegate that. So the government delegate the regulation to the SEC. So the government delegate the regulation to the SEC as well as the practice, the accounting practice. Okay. And then the SEC delegate that responsibility to the private sector, auditing community. Interesting. In 1939. Interesting. Holy moly. All right. So the management discussions and analysis of financial conditions and report operation or result operations disclose informations that are relevant to investors that about that financial statements show or do not show, as well as important trends and risks. That have shaped the past or are reasonably likely to shape the company's future. So the SEC rules governing MD&A require disclosure about trends, events, or uncertainties known to management that will have a material impact on reported financial information. The purpose of the MD&A is to provide investors with information that the company management believes to be necessary to understanding of its financial condition, changes in financial conditions, and result of operations. So it is intended to help investors to see the company through the eye of management. It is also intended to provide context for the financial statement and information about the company earnings and cash flow. So this section here helps investors to helps investors is to see the company through is to look at the information through the company management eyes. Through the company management eyes that are believe or that they believe that this is necessary to understand its financial condition and performance. It is also intended to provide more context for the financial statement. Okay, it also provides more context for the financial statement and information about the company earnings and cash flow. The MD&A. So for example, if I want to look at MD&A of Apple here, investor relations, like this, SEC filing. Okay. Quarterly report. Form 4, statement of change, the beneficial ownership of security. But this is not financial statement. Current reporting filing. Quarterly report. Security and Exchange Commission, United States, Form 10Q, quarterly report pursuant to Section 13 and 15 of the Security Exchange Act in 1934. Oh my God. Interesting. The Security Exchange Act of 1934, Apple Inc., California, State of Jurisdiction and Incorporation, One Apple, Parkway, Cupertino, California, IRS, Employees Identification Number, zip code, registration telephone. But this is what? Form 10Q. Common stocks per value per share. Name of exchange on which register. Notes due 2024. But this doesn't show is, that's right, financial statement. Financial statement, management discussion and analysis of financial conditions and results operations. Okay. So let me take a look at the financial statement here. This is net sales, cost of sale. This is the cash flow. No, the income statement. Condensed consolidated statement of operations. Unaudited. consolidated in millions. 73, holy shit, 73 billions. You got products, service, cost of sales, operating expense, operating incomes, earned per share, diluted. Condensed consolidation statement of comprehensive income. And this is of operations. But this is from income statement. As well as this. Net income. Comprehensible income. And this is the balance sheets. Assets, liabilities, and shareholders' equity. Retained earnings, accumulated deficit, accumulated other comprehensible income, and total shareholder. Exactly. Accounts payable, other current liabilities, deferred revenue, commercial paper, term debt, cash and cash equivalents, marketable securities, accounts receivable, inventory, vendor note, trade receivable, accounts receivable, cash and cash equivalent. There's a big portion of this company that have cash. Non-current assets. Okay, marketable securities, property, plant, and equipment, other non-current assets. Okay, condensed consolidated statement of shareholders' equity, unaudited. Condensed consolidated statement of cash flow. Okay. And this is cash flow. Operating activities, net income, investing, purchase of marketable security, proceeds from maturity of marketable securities, proceeds from sales of marketable securities, payment for acquisition of property, plant and equipment, others, financing activity, payment for tax related to net share, payment for dividends and dividends equivalent, repurchased common stocks, repayment of term debt, proceed from repayments of commercial paper net. But they don't show things like increase or decrease in cash and cash equivalents and restricted cash. Beginning balance. Notes to condensed consolidation financial statement unaudited. Basis of presentations and preparation. Revenue, financial instruments, money market fund, mutual funds, U.S. Treasury security, U.S. agency security, non-U.S. government security, certificate of deposit and time deposit, commercial paper, corporate debt security, municipal security, mortgage and asset-backed securities. All right. Interest rate risk, accounts receivable. Can I go back here at the now management discussion and analysis like this, where this section provide more information to investors. Okay, so this section helps investors to provide more context about the financial statement. Okay, to provide more context about the financial statement, uh, and the information and information about the company earnings and cash flow. So the whole point of this is an opportunity to tell investors what the financial statement show and do not show. So important trends and risks that have shaped the past or the reasonable likely to shape the company's future. Okay, so important trends and risks that have shaped the past or a reasonable likely to shape the future of the company. Available information, business seasonality, and product introductions, fiscal period year, quarterly highlights, macroeconomics conditions, segment operations performance. Americas net sales decreased during the second quarter and first 6 months of 2023 compared to the same period in 2022, due primarily to lower net sales of iPhone and Mac, partially offset by higher net sales of servers. Europe. The weakness in foreign currencies related to the US dollar has had a net unfavorable year-over-year impact on Europe net sales during the second quarter and first 6 months of 2023. During the second quarter of 2023, the Europe net sales increased consisted in the Europe net sales increase consistent primarily of higher net sale of phone, partially offset by lower net sale of Mac. During the first 6 months of 2023, the Europe net sales decreased. During the first 6 months of 2023, the Europe net sales decrease consisted primarily of lower net sales of Mac, partially offset by higher net sales in iPhone. So they measuring it by quarterly, and in Americas, I want to say Americas, I don't know what does it mean Americas for them. America's net sales decreased during the second quarter and during the second quarter and fixed 6 months of 2023 to the same periods of 2022. The weakness in the renminbi related to the US dollar has an unfavorable year-over-year impact of Greater China net sales during the second quarter and the first 6 months of 2023. The weakness in the yen as well. During the second quarter and first 6 months of 2023. iPhone net sales were relatively flat. Mac net sales decreased during the second quarter and first 6 months. iPad net sales decreased during the second quarter of 2023 compared to the second quarter of 2022, due primarily to lower net sales. Wearables. Service. The servers increased. The wearables were flat. The iPad, Mac decreased, and iPhone, just their flagships. This is their flagships. Interesting. Gross margin. product gross margin, service gross margin, operating expense, research and development, selling, general, administrating, liquidity and capital resources, commercial paper, manufacturing purchase obligations, capital return programs. Okay, so here, this management discussions and analysis of financial conditions and report operations are crucial to investors. Okay, are crucial to investors. Because it provides information that financial statement can or cannot disclose, as well as allow these sections to, or helps investors to see. So this section helps investors to see through the company management eyes. Through the company management eyes. Okay. So it can help. Okay. This section it also helps investors to see trends. Okay. This section is also helps investors to show important trends and risks that have shaped or are reasonably likely to shape the future of the company future. So for example, here in the Americas, when they mention here, when they talk about this, right, the macroeconomic conditions in the Americas, Europe, Greater China, Japan, and rest of the Asia Pacific. Very, very interesting. So with that, that'll be all for this video. Take care. Bye-bye.